This is Macro Horizons, episode 326, Judging Trump, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 2nd. And as the Liberation Day reciprocal tariffs face increased legal scrutiny, we're reminded that court battles are not unfamiliar territory for President Trump. Don't worry, he'll be back. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market managed to stage a reasonable rally with 10-year yields coming off of the recent peaks and consolidating comfortably below 450. Now, this occurred at a moment when the long bond also improved. All this was supported by a strong takedown of the 7-year auction. It was $44 billion worth of 7-year notes that came on Thursday, and it stopped through an impressive 2.2 basis points. Now, this is notable because it also came with the largest non-dealer allocation for any Treasury coupon auction on record. So an impressive showing at a moment when the market still remains concerned about a potential buyer's strike for U.S. Treasuries. If nothing else, combined with the fact that the 5-year auction stopped through 0.4 of a basis point and the 2-year auction also stopped through nearly a full basis point, all suggest that there is ongoing demand for Treasuries in this environment. The market was also afforded a solid print on the core PCE number at a 0.116 on an unrounded basis, and this brought the year-over-year pace to 2.5%. The biggest surprise in terms of the PCE report was the upside on personal income, which came in up 0.8% during April versus the up 0.7% in March. For context, the market was anticipating a 0.3% print. We also had a surprising narrowing of the goods deficit. For the month of April, the goods deficit narrowed to $87.6 billion. That was effectively half of what we saw in March, which was negative $162 billion. The takeaway being that the negative implications from net exports seen in Q1 are unlikely to unfold yet again in Q2. So that is certainly a positive for the economic outlook, and it also implies that Trump will have more flexibility in terms of timing as he pushes forward with his global trade agenda. Trump's trade war did suffer a setback insofar as a court ruling against the reciprocal tariffs. Now, the administration has said that if they lose the case in appeal, they have a Plan B for implementing the tariffs. However, the outlines of Plan B imply a greater deal of uncertainty as well as a longer timeline. So, as a result, the market will be closely following the verdict of the appeal, as it will have implications for the extent to which tariffs will be realized over the summer months, as well as the perception of how aggressive Trump can be in this regard going forward. Our takeaway is that while the Treasury market has pulled back from some of the recent extremes, we're still going to be in a range trade with a theme of consolidation over a clear trending market. Now, we're translating this into incrementally lower 10 and 30-year rates with a nod to the fact that the 2-year remains well anchored to monetary policy expectations, and the Fed isn't expected to resume normalization anytime soon.
It was a shortened week following the Memorial Day holiday in the US, but that doesn't mean we were want for any important developments. It was less about the evolution of the economy over the week just past, and more about the next phase in what has been a year defined by trade policy in Washington, with early headlines that a court was blocking Trump's tariffs, only to be moderated from a market impact perspective by the fact that that didn't really mean much, and then another appeals court saying nothing has changed, at least for the time being. Frankly, ahead of Friday's core PCE data, that was really the most notable development in the rates market this past week, along with a series of very strong Treasury auctions, 2s, 5s, and 7s all stopping well through, which added to the bullishness that we've seen continue to bring 10-year yields off their latest highs.
It is notable that the deficit concerns that pushed rates back to the local highs have moderated somewhat, and in part, if we put this in the context of legal challenges against Trump's tariffs, that means that the budget, which made it through the House, based at least in part on increased tariff revenue, will face greater scrutiny in the Senate. So we're left to consider whether or not that increases the probability that we run up against a debt ceiling issue this round, or if there's a quick resolution on the legal side which keeps Trump's agenda on track going forward. All else being equal, our biggest takeaway from the last week's worth of developments is that the period of uncertainty has been extended yet again.
And regardless of what ultimately comes to pass in terms of the legal challenges and what promises to be ongoing headlines back and forth around what is actually enforceable as it relates to tariffs, it's that uncertainty that we maintain is the most important aspect of the current episode of the trade war. Yes, within this week's consumer confidence data, we saw an impressive upside surprise, presumably as a function of some of the walk back of more severe tariffs earlier this month, especially with China and what that meant for risk asset performance, but away from simply household confidence and a willingness to spend, or not, we continue to hear, both anecdotally but also via communication from Fed speakers, that on a business level, CapEx is being delayed, hiring plans are being stalled, and the business of expansion is moving to the sidelines. Now what remains to be seen is how quickly that might bounce back in response to the changing assumptions around tariffs, but clearly for the time being, from a business perspective and the overall level of investment and growth, it's clear that the uncertainty, if not the tariffs themselves, are having a negative impact.
And it will be very interesting to see how the trade negotiations are impacted by the legal challenge to the tariff regime. It's not difficult to imagine that if you're Canada, China, Mexico, for example, you're watching the drama unfold in Washington and in the court system and viewing it from the perspective of declining power on Trump's side. After all, if the courts are going to rein in some of Trump's extreme levies announced on Liberation Day, then it's reasonably safe to assume that that was the peak for pricing in the risk of higher tariffs, and that forward negotiations might be a bit more balanced, if nothing else.
And it's that narrative that we'll argue has translated to what has become an increasingly bearish consensus around treasuries over the balance of the year. Obviously, the bear steepening trade that was touted as the classic way to play Trump's victory in the rates market around the election has come to face the realities of the growth implications from tariffs. Now that we've seen that risk start to moderate, and as you mentioned, even maybe the peak of that worry is already behind us, now what we've seen is a reemergence of the view that being short or underweight the long end of the curve versus the front end, given that the Fed is in no rush to cut, but nonetheless still biased to cut at some point later this year. In so many words, that means that the steepener is back and the market is collectively looking for an ongoing grind toward higher yields and positioned as such. Now, had this all been taking place from a departure point with 10-year yields at 375, we might be a bit more on board with the interpretation that yields have room to rise, at least on a tactical basis, but coming off last week's yield highs, and given that 10s are still so comfortably above 4%, we'll argue on a go-forward basis there's enough asymmetry and risks facing the economy that treasuries at these levels are still appealing, and this week's auctions reinforce that idea.
In this context, it's also worth observing that market conversations have been largely centered around what it would take to get 30-year yields to 6%, not what it would take to get 30-year yields back to 4.25, for example. Said differently, the market narrative is skewed decidedly to the bond bearish side at the moment, and that means that the pain trade is towards lower rates. Now, Ben, to your point, we do like the steepener conceptually. However, given that the front end of the curve will be largely anchored to a relatively narrow trading range until the Fed actually starts the process of cutting rates, we're more concerned that any buying interest further out the curve, particularly in 10s and 30s, will translate into a knee-jerk bull flattener as opposed to a cyclical bull steepener, which we do ultimately anticipate will emerge at one point. However, in light of the prevailing uncertainties, both in terms of the trade war as well as the eventual impact on the real economy, the Fed's wait-and-see stance is completely justified, and we don't see that changing anytime soon. We do think that the first live meeting for a rate cut in 2025 will be September. However, when we have the updated dot plot and the SEP in the middle of June, policymakers will be afforded the opportunity to once again signal how many rate cuts they have penciled in for the year. Maintaining 50 basis points or 225 basis point rate cuts seems to be the path of least resistance, although it will be especially informative to see the extent to which the GDP estimates and core PCE estimates are adjusted to reflect what is now a fair amount of information regarding the trade war. All else being equal, we think lower growth, higher unemployment, stickier core PCE should be one's operating assumption.
And this past week, we also got the minutes of the May FOMC meeting, which didn't really show any material surprises, and the market was content to take the discussion in greater detail around the Fed's meeting earlier this month in stride. But what it did show from a bit of a longer-term perspective was an official acknowledgement from a monetary policy perspective that tariffs were ultimately more severe and more broad-based than was initially assumed, and that in turn has ratcheted up the level of uncertainty, and importantly, for the discussion around what may come to the next update in the SEP, introduced more upside inflation risks. Now, as we've heard from Powell and others, for the bulk of the past several quarters, the risks to the dual mandate have been two-sided and more or less symmetric. We'll argue that the Fed and the market is in the process of moderating those symmetric assumptions in favor of a bit more weighting on the inflation side of the equation. After all, we now have 4 months' worth of payrolls data in 2025 so far, and sure, that doesn't capture the bulk of the impact of the tariff uncertainty. It nonetheless has set a strong departure point for the labor market to withstand any downside shock that ultimately does come to pass. So the Fed has some breathing room in terms of not needing to immediately respond via a rate cut to any softening on the employment side of the dual mandate, all while the inflation outlook continues to firm, both as a mechanical function of higher tariffs, but also the fact that the economic data has continued to hold up relatively well, despite rates at these levels and despite the broader uncertainty. Now, have we reached the point where this really puts the Fed's easing bias at risk? It's a bit premature to make that assertion, but it certainly increases the risk that the FOMC will wait even longer to deliver their next rate cut.
And it's also worth keeping in mind that given where we are in the debt ceiling cycle, that the TGA is being actively drained, which is, in effect, a form of QE at a moment where the Fed is content to be on hold to see how things unfold with the trade war. Now, eventually, that will all change, and change rather dramatically once some type of agreement is reached on the debt ceiling and the TGA is replenished, which will translate into a sharp increase in bill issuance. Now, at the end of the day, from a supply perspective, it all nets out, i.e. the draining of TGA and the replenishment of it. However, the timing is relevant, particularly as the market remains focused on the September 15th tax day as the potential X-date for the Treasury Department's funding.
And while we'd like to say that the composition of Congress and the fact that there's a Republican in the White House means that this debt ceiling episode will be different, and there promises to be either a suspension or raise of the government's borrowing capacity well before the Treasury Department runs the risk of a late bill payment, the fact of the matter is, given the division within the Republican Party itself and within Washington more broadly, that's probably a bit optimistic. And so what that means is, as summer gets underway, there promises to be continued discussions on contingency plans for the what-if of a late payment, and a greater refining of estimates around when it is the Treasury Department will actually run out of money. Now, do we ultimately think this time will be any different? No, it will probably be an 11th hour resolution, and then we will once again look forward to the brief period of calm before the next debt ceiling.
Has this time ever been different?
No, but maybe next time.
In the week ahead, the Treasury market will have the benefit of a variety of fundamental inputs from which to derive trading direction. The highlight will be on Friday, which will see May's non-farm payrolls print. The consensus is currently for 130,000 jobs to be added, with the unemployment rate held steady at 4.2%. Now, we'll note that we have recently seen an increase in unemployment claims, reaching 240,000. However, that was not for non-farm payroll survey week, and therefore, if that does represent the beginning of a trend, won't be evident until we see June's data. The week ahead also contains the typical pre-payrolls releases, including ADP, the JOLT series, as well as ISM Manufacturing and ISM Services. We'll be watching the Challenger layoff survey as well, although it does warrant acknowledging that we've seen an increase in layoff announcements that have not ultimately translated through into lower payrolls. We'll also get a full slate of Fed speakers, including Powell on Monday afternoon, and given the amount of criticism that Trump has levied against Powell in particular, but the Fed more broadly, we'll be looking for any nuance to the messaging, although we anticipate that the Fed's wait-and-see stance will remain decidedly in place. Keep in mind that the June 18th FOMC meeting means that this will be the final week for any shift in Fed rhetoric in the event that the committee seeks to change the messaging ahead of the June 18th meeting. That being said, in light of all the uncertainties created by the trade war, we don't see any incentive for the FOMC to shift its rhetoric at this point. We're anticipating that in the absence of any major data shock, the process of consolidation will continue, and it's worth a nod to the fact that the seasonals in the Treasury market tend to be bond-friendly, as rates drift lower over the summer months, and early June has tended to be the departure point for this trend taking hold. That being said, there's nothing ironclad about the seasonal patterns, and as we look forward, it's easy to envision risks on either side leading to another backup in rates, eventually one that we would assume would be purchased, or an extension of the consolidation that puts 4% 10-year yields back on the table. All else being equal, we remain biased towards lower rates, and in the 5% versus 4% debate on 10-year yields, we fall decidedly in the 4% camp. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the recent developments have turned us into armchair lawyers, as well as armchair strategists and armchair Fed watchers, it strikes us that maybe we should get into the armchair business. But tariffs are too high. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.